All right, let's get a move on then and connect with Daniel Lim, who is head equity strategy at Standard Chartered Wealth Management, to get in a sense as to what he makes of the kind of indicators that we've seen from across the globe. And with that inflation number coming in far higher than what the street was penciling in, what do you believe is going to be the trajectory going forward when it comes to the US Fed action, Daniel?
Well, I think, yes, the data was, you know, definitely on the high side. And that means that the Fed is very likely going to be hiking 75 bips later on this month. And if you look at these, core indicators, the core inflation is certainly, also firmer than expected. House pricing, the rent, shelter, and also the gasoline prices are certainly very, very firm. So basically, what that means is that we are probably going to be seeing this lingering on and be the key theme going forward in the markets in the near future. Now, the silver lining to this is that the oil prices are already starting to come off. They have been. And that may alleviate the pressure later on. But I think that right now, I think the Fed is still going to be erring on the side of caution and trying to control inflation. That will be their priority.
Morning, this is Anisha also joining into the conversation. Well, you talked about your expectation of around 75 basis point hike when the Fed meets on July 26 and 27, but now the market is also pricing in an expectation that there might be a 100 basis point hike. At least that is what NOMURA is saying, and the probability now stands at 82% for that particular scenario as well. What's your reading of what the chances are of 100 basis point, and if it does happen, would the market be negatively surprised, you think?
Well, I think basically, if you look at the reaction of, say, the growth versus the value stocks, it is very interesting here, right? Because the value stocks, such as the energy stocks, they are trying to have some kind of rebound last night, but they actually did not do so well after that, ending up nearly flat. But in terms of other stocks, such as the growth stocks, the big cap NASDAQ growth stocks, they actually came off from the bottom very well overnight. So what that means is that the growth scarcity is coming back, and people are worried about recessionary risk. And therefore, you're seeing stocks such as energy, which is highly sensitive to the economic growth. You can see them, I guess, coming off and failing to stage a significant rebound. And that's very interesting. So I do think that people are attaching a growth scarcity, growth premium to the growth stocks. And also you're seeing that the yields are getting capped as well because of this. People are rotating and seeking their investment into income generating assets.
Good morning. The other question to watch out for, the dollar that has retreated from a 20-year high. We all were talking, of course, about the parity with the euro, 1:1. But back home in India, we also track the dollar index so closely because seems to be there is a correlation between that, flows, fear of flight of capital. So when you see also the bond markets, the inversion of the 2-year and the 10-year yields, what's happening with the dollar index, what's your sense when it comes to maybe the flows, foreign investors going back home to America?
Yes, there is flight to safety. And you do see that, like I said, the popular or the large cap names in the US are actually holding up very well, right? Like the typical growth stocks in the US. So that's one thing that we are noticing. The reason why the dollar is so strong is also because of the woes that we're experiencing in Europe, right? Because they are actually at an even more front and center than the US in terms of the energy crisis. Remember that in terms of the sensitivity of the European GDP, is actually twice as sensitive to energy prices versus the US. And also, of course, the link of food inflation as well in Europe, right? Because due to the war between Russia and Ukraine, food supplies are getting disrupted because Ukraine obviously is a big supplier of food to Europe. So that means that the weakness in the euro versus the dollar is likely to continue. And remember that euro is actually 50% of the DXY index versus the dollar.
Thanks much, Daniel, for joining in and sharing with us your outlook as to what could possibly be the course of action for the US Fed, as we've seen that US inflation print coming in at the highest in the last 4 decades.